Quote of the day: investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. Paul Samuelson. Welcome to a world of endless financial possibilities. If you're a beginner in the investing game, you're in the right place. In this video, we'll unveil the stock market secrets that will set you on a path to financial triumph. Whether you dream of retiring comfortably, buying your dream home, or simply growing your wealth, the stock market can make it happen. But first, you need to understand the basics. Segment 1: Demystifying the stock market. Let's start by demystifying the stock market. It's not as complex as it may seem. At its core, it's a place where you can buy and sell ownership in companies. But how do you get started? The stock market, often depicted as a labyrinth of numbers, charts, and financial jargon, can be intimidating for beginners. However, at its core, it's a platform where investors buy and sell shares of ownership in companies. Imagine the stock market as a bustling marketplace where you can become a part owner of some of the world's most renowned businesses, such as Apple, Microsoft, or Amazon. To simplify this concept, think of stocks as pieces of a gigantic puzzle. Each piece represents a share in a company. When you own these pieces, you essentially have a stake in the company's success and its profits. The more pieces you own, the more significant your ownership in that company. One fundamental term to grasp is ticker symbols. These are short, unique codes assigned to each publicly traded company, making it easy to identify them in the market. For instance, Apple's ticker symbol is Apple, while Amazon's is Amazon. Buying and selling stocks is facilitated through brokerage accounts, which you can easily open with online brokerage firms. These accounts serve as your gateway to the stock market, allowing you to place orders to buy or sell shares. Buying and selling stocks is facilitated through brokerage accounts, which you can easily open with online brokerage firms. These accounts serve as your gateway to the stock market, allowing you to place orders to buy or sell shares. Understanding market orders and limit orders is crucial. A market order instructs your broker to buy or sell a stock immediately at the current market price. It is the simplest and most common type of order used in financial markets because it's the quickest to be fulfilled, usually at a price close to what investors expect. In contrast, a limit order is an instruction to purchase or sell a particular security at the best available price as soon as possible. A limit order guarantees that an order is filled at or better than a specific price level. A limit order is not guaranteed to be filled. However, limit orders control execution price but can result in missed opportunities in fast-moving market conditions. Limit orders can be used in conjunction with stop orders to prevent large downside losses. A limit order is usually valid for either a specific number of days, as example, 30 days, until the order is filled or until the trader cancels the order. Moreover, the stock market operates on the principles of supply and demand. When more people want to buy a particular stock than sell it, its price increases. Conversely, when more people want to sell than buy, the price falls. This fluctuation in stock prices creates opportunities for investors to buy low and sell high, a fundamental strategy in stock investing. So, don't let the complexity of the stock market deter you. It's a place where you can become a part owner of thriving companies, and with the proper knowledge and strategies, you can navigate it confidently and profitably. Stay tuned as we delve deeper into the exciting world of investing in this video. Segment 2: The Power of Compounding. Compounding is often referred to as the eighth wonder of the world, and for good reason. It's a concept that holds incredible potential for investors, especially beginners, as it can significantly amplify the growth of your investments over time. At its essence, compounding is the process where your investments generate earnings, and those earnings, in turn, generate more earnings. It's like a snowball rolling downhill, gradually picking up size and momentum. The longer your money remains invested, the more influential the compounding effect becomes. Let's illustrate this with a simple example. Imagine you invest $1,000 in the stock market, and on average, your investments generate an annual return of 8%. In the first year, your investment grows by $80, 8% of $1,000. Now, you have $1,080. In the second year, that 8% return isn't just on your initial $1,000, it's on the entire $1,080. This means your return is $86.40, and your total investment grows to $1,166.40. As time passes, this process accelerates exponentially. Over 10 years, your initial $1,000 can double or potentially grow into thousands of dollars, depending on the interest rate change and thanks to the power of compounding. Now, imagine what this means for your long-term financial goals, whether it's building a retirement nest egg, buying a home, or achieving financial freedom. Compounding allows you to harness time as your ally, turning small, regular contributions into substantial wealth. The key takeaway here is that the earlier you start investing, the more time your money has to compound and grow. This is why seasoned investors often emphasize the importance of getting started as soon as possible, even with small amounts. It's not about how much you invest, it's about how long you stay invested. In the upcoming segments of this video, we'll delve deeper into strategies and techniques that leverage the power of compounding to help you achieve your financial goals. So, stay tuned and get ready to unlock the full potential of your investments. Segment 3. Building a diversified portfolio. Building a diversified portfolio is akin to constructing a resilient financial fortress. It's a strategy that spreads your investments across a variety of asset classes, industries, and geographic regions, reducing the risk associated with individual assets and enhancing the overall stability of your portfolio. Imagine your portfolio as a pie, and each slice represents a different type of investment. Diversification ensures that no single slice dominates the pie. This means if one investment underperforms or experiences a downturn, the other slices can help offset those losses. Asset classes. Diversification begins with allocating your investments across different asset classes. These typically include stocks, bonds, and cash equivalents. Each asset class has its own risk and return profile. Stocks offer the potential for higher returns but come with greater volatility, while bonds are generally more stable but offer lower returns. By holding a mix of these assets, you balance risk and potential reward. Industries. Another layer of diversification involves spreading your investments across various industries. Industries can perform differently under different economic conditions. For instance, during an economic downturn, healthcare and consumer staples companies may be more resilient, while technology and consumer discretionary companies could face challenges. Having exposure to multiple industries ensures that your portfolio isn't overly dependent on the performance of a single sector. Geographic regions. Diversifying across geographic regions is equally crucial. Different countries and regions may experience economic cycles independently. By investing in global markets, you reduce the risk associated with the economic performance of a single country. This can also provide opportunities for growth in regions that are outperforming others. A well-diversified portfolio seeks to strike a balance between risk and return. While diversification doesn't guarantee profits or prevent losses, it does help manage risk more effectively. It's a time-tested strategy that aligns with the age-old wisdom of not putting all your eggs in one basket. Risk management. Diversification aligns with the principle of risk management. By avoiding overconcentration in any one investment, you reduce the potential impact of poor performance in a single asset on your overall wealth. This risk mitigation strategy can help you stay on course even during challenging market conditions. In the subsequent segments, we'll explore specific investment strategies and techniques that will empower you to diversify your portfolio effectively. Remember, the path to financial success often begins with prudent risk management and diversification. Stay tuned to unlock the full potential of your investments. Segment 4. Time-tested investment strategies. Get ready to discover some time-tested investment strategies that even beginners can employ. From dollar-cost averaging to value investing, we'll break down these strategies in a way that's easy to understand and apply. In the realm of investing, seasoned investors often rely on tried-and-true strategies that have withstood the test of time. These strategies provide a framework for making informed investment decisions and managing risk effectively. For beginners, understanding and implementing these strategies can be the cornerstone of a successful investment journey. Dollar-cost averaging, DCA. One of the most accessible and effective strategies for beginners is dollar-cost averaging. This approach involves investing a fixed amount of money at regular intervals, regardless of the market's ups and downs. DCA allows investors to buy more shares when prices are low and fewer shares when prices are high. Over time, this strategy can result in a lower average cost per share and reduce the impact of market volatility. For instance, if you invest $100 monthly in a particular stock, you'll buy more shares when the stock price is low and fewer when it's high. This smooths out the impact of market fluctuations, making it a less emotionally charged way to invest. Value investing. Value investing is another strategy endorsed by legendary investors like Warren Buffett. This strategy involves identifying undervalued stocks, those trading below their intrinsic value. Investors seek out companies with strong fundamentals, solid financials, and growth potential that the market has overlooked or undervalued. Value investors believe that over time, the market will recognize the true value of these stocks, leading to price appreciation. Adopting a value investing mindset can help beginners identify sound investment opportunities and build a portfolio of undervalued assets. Buy and hold. The buy and hold strategy advocates purchasing quality investments and holding them for the long term, often for several years or even decades. This approach relies on the historical trend of the stock market, which tends to rise over the long run despite short-term fluctuations. For beginners, the buy and hold strategy simplifies the investment process and reduces the need for frequent trading. It encourages patience and discipline while allowing your investments the time they need to grow. Index fund investing. Investing in index funds is another strategy favored by many investors. These funds replicate the performance of a specific market index, such as the S&P 500. They offer instant diversification across a wide range of stocks, reducing the risk associated with individual company performance. For beginners, index funds provide a low-cost and low-maintenance way to gain exposure to the broader market. They often outperform actively managed funds over the long term due to their lower fees. These time-tested investment strategies serve as valuable tools in the arsenal of any investor, especially beginners. They provide a structured approach to investing, reducing emotional decision-making and helping you navigate the complexities of the market with confidence. As we delve deeper into these strategies in subsequent segments, you'll gain the knowledge and skills needed to apply them effectively in your investment journey. Segment 5: Risk Management. Risk is an integral part of investing, but it doesn't have to be daunting. We'll walk you through the art of risk management and how to protect your investments in times of market volatility. In the world of investing, risk is an ever-present factor that can't be entirely eliminated. However, it can be managed and mitigated through prudent risk management strategies. This segment will delve into the importance of risk management and some essential techniques for beginners to consider. Diversification revisited. Diversification, which we discussed earlier, plays a central role in risk management. By spreading investments across various asset classes, industries, and geographic regions, you reduce the risk associated with any single investment. This means that a poor-performing asset won't have a catastrophic impact on your overall portfolio. Diversification is your first line of defense against excessive risk. It's important to note that diversification doesn't eliminate all risk, but it balances risk with potential reward. It's like having multiple safety nets to catch you if one fails. For beginners, diversifying your investment should be a foundational principle of your investment strategy. Asset allocation. Asset allocation is the process of determining how much of your portfolio should be invested in different asset classes. It's a crucial aspect of risk management because it ensures that your investments align with your risk tolerance and financial goals. For example, if you have a lower risk tolerance, your allocation may lean more toward bonds and cash equivalents, which are generally less volatile than stocks. As you gain experience and your financial situation evolves, you can adjust your asset allocation to reflect changing circumstances. Asset allocation is a dynamic aspect of your investment strategy that requires periodic review and adjustment. Risk tolerance assessment. Understanding your risk tolerance is essential for effective risk management. Your risk tolerance is influenced by factors such as your financial goals, time horizon, and emotional capacity to withstand market fluctuations. It's crucial to strike a balance between your risk tolerance and potential returns. As a beginner, it's advisable to start with a conservative approach, gradually increasing your risk exposure as you become more comfortable with market dynamics. Over time, you'll develop a better sense of your risk tolerance and how it aligns with your investment goals. Emergency fund. A fundamental risk management tool is having an emergency fund. This is a reserve of cash set aside to cover unexpected expenses, such as medical bills or car repairs, without the need to liquidate investments at an inopportune time. Maintaining an emergency fund provides peace of mind and ensures that your investments can remain untouched during unforeseen circumstances. In summary, risk management is a critical component of any investment strategy, especially for beginners. It involves diversifying your investments, allocating assets according to your risk tolerance, assessing your risk tolerance, and maintaining an emergency fund. These strategies collectively reduce the impact of market volatility and help safeguard your financial future. As we continue to explore risk management techniques, you'll gain a deeper understanding of how to protect and grow your investments effectively. Segment 6: The emotional side of investing. Lastly, we'll delve into the emotional side of investing. Mastering your emotions is key to becoming a successful investor. We'll provide tips and techniques to keep your emotions in check and make rational decisions. Investing isn't just about numbers and charts, it's also deeply influenced by human emotions. Understanding and managing these emotions is a critical aspect of successful investing, especially for beginners who may find themselves more susceptible to emotional swings in the market. Fear and greed. Two dominant emotions that often drive investment decisions are fear and greed. When markets are in turmoil, fear can prompt investors to sell their investments out of panic, locking in losses. Conversely, when markets are soaring, greed may lead to overconfidence and excessive risk-taking. For beginners, it's essential to recognize these emotions and their potential impact on decision-making. Developing a disciplined approach to investing can help counteract the emotional rollercoaster and avoid impulsive actions. Long-term perspective. One effective strategy to manage emotions is adopting a long-term perspective. Understand that market fluctuations are part of the investment journey, and they don't necessarily reflect the long-term value of your investments. For instance, historical data shows that despite periodic downturns, the stock market has generally trended upwards over time. By focusing on your long-term goals and maintaining a steady course, you can avoid making hasty decisions based on short-term emotions. Having a well-defined investment plan with clear objectives can act as your anchor during turbulent times. Staying informed, not overwhelmed. While staying informed about market developments is essential, it's equally important not to be overwhelmed by the constant barrage of news and opinions. News outlets often amplify market volatility, which can stir emotions and lead to impulsive actions. Beginners should strive for a balanced approach. Consider setting specific times for reviewing your investments and avoid making snap decisions based on breaking news. Remember that markets tend to overreact to news events, and this can create opportunities for disciplined investors. Seeking professional advice. For those who feel overwhelmed or unsure about their investment decisions, seeking professional advice can be a wise step. Financial advisors can provide guidance, create a tailored investment strategy, and offer a steady hand during turbulent times. Their experience and expertise can help you navigate the emotional aspects of investing. Financial advisors don't believe in a one-size-fits-all approach. They recognize that each investor has unique goals, risk tolerance, and financial circumstances. When you consult with a professional advisor, they take the time to understand your individual needs and aspirations. They work closely with you to craft a personalized investment strategy that aligns with your long-term objectives. Additionally, many financial advisors operate under a fiduciary duty, which means they are legally obligated to act in your best interests. This ensures that their advice is impartial and driven solely by your financial well-being. Seeking professional advice is not a sign of weakness, but rather a strategic move for investors at all levels, especially beginners. Financial advisors provide expertise, guidance, and emotional support that can make a world of difference in your investment journey. They are your partners in building a secure financial future, helping you navigate the complexities of the financial world with confidence and peace of mind. So, if you ever feel in doubt or overwhelmed, consider consulting a financial advisor to guide you toward your financial goals. Emotional resilience. Lastly, developing emotional resilience is an ongoing process. It involves recognizing your emotional triggers, staying disciplined, and learning from both successes and setbacks. Over time, you'll build the emotional fortitude needed to make rational investment decisions. In the world of investing, perhaps one of the most valuable skills you can acquire is the art of staying calm when market storms rage. It's a skill honed through experience and discipline, allowing you to weather the inevitable ups and downs of the financial markets with unwavering composure. Mastering this art involves understanding that market volatility is a natural part of the investment journey, and that panicking during turbulent times can lead to hasty decisions and regret. Instead, it's about having a well-thought-out strategy, a long-term perspective, and the mental fortitude to stay focused on your financial goals, even when the seas are rough. When you can navigate the stormy waters of the market with grace and resilience, you're better positioned to make sound investment choices and ultimately achieve financial success. In conclusion, the emotional side of investing is a real and impactful aspect of the journey, particularly for beginners. Understanding common emotional pitfalls, maintaining a long-term perspective, staying informed without being overwhelmed, seeking professional advice when needed, and developing emotional resilience are all strategies to help manage emotions and make more informed investment choices. As we continue to explore the emotional aspects of investing in these video series, you'll gain valuable insights into mastering the art of staying calm in the midst of market storms. And there you have it, stock market secrets for beginners. We've covered the fundamentals, compounding, portfolio diversification, smart strategies, risk management, and emotional mastery. It's time to embark on your investing journey with confidence. Don't miss out on the incredible opportunities the stock market has to offer. Remember, the key is knowledge and smart decisions. Hit that subscribe button, like this video, and share it with fellow beginners who are ready to take control of their financial future. Stay tuned for more valuable insights, and together, we'll unlock the secrets to financial success.